All right. Before we get started, just the usual but very important reminder. This is all for educational purposes. It is definitely not financial advice. You know the drill in crypto. Always do your own research because every single investment carries risk. Welcome, everyone. Today, we're going to do a deep dive, a proper case study. We're going to look at how a protocol's design can be engineered to not just get through a bear market, but to actually use that market fear as a real structural advantage. And our subject is PLAZM, focusing specifically on what happened on day 191. So let's kick things off with a real head-scratcher, a paradox that seems to fly in the face of all conventional market logic. We're looking at a day where two things happened that just shouldn't happen at the same time: absolute extreme fear and real measurable protocol growth. So how is that even possible?
Okay, so on day 191, the market was in a state of sheer terror. The crypto fear and greed index was sitting at just 17. Now, that's not just fear, that is deep and extreme fear territory. This is the kind of number you see when people are panic selling and capital is just fleeing the space.
And yet, look at this. On that very same day, the protocol saw nearly 9 fresh ETH, worth around $20,000, flow into its treasury. This wasn't some internal transfer. This was new capital coming in, buying bonds and investing in the system. The vault actually got bigger on a day when all logic says it should have gotten smaller. So this leads us to the big question for today's case study. How in the world is this possible? How does a protocol manage to attract 20 grand in new money on one of the scariest days in recent crypto memory? Well, the answer isn't in sentiment, it's in the architecture. And to find that answer, we've got to pop the hood and look at the protocol's core mechanics. This is what we're calling the anti-fragile engine. It's a system that just hums along in the background, totally ignoring whether the market is panicking or popping champagne. Now, to really get this, we need to be clear on a key term: anti-fragile. You see, an anti-fragile system is something special. It doesn't just survive stress, it actually gets stronger from it. And in PLAZM's world, the yield engine doesn't care about feelings. Its output is tied to the cold, hard mathematics of its bond positions. Period. And here's the proof in the pudding. On that day of extreme fear, day 191, the protocol still cranked out nearly $400 in real, actual economic yield. This didn't happen because traders were optimistic. It happened because the underlying math of the bonds just kept working, day in and day out, just like it's designed to. It's a machine that literally does not care what the fear and greed index says. Now, here's where it gets really fascinating. What happens to that yield? It's automatically split and put to work in 3 ways. First, you've got buy and burn, where most of the yield buys PLAZM on the market and poof, destroys it forever, shrinking the supply. Second is buy and build, which adds to the protocol's own liquidity, making it more robust. And third, my favorite, buy and grow, which plows that yield right back into buying more of the assets that create the yield in the first place. It's just a beautiful self-compounding flywheel. And this leads us to a really critical point. The protocol isn't just ignoring fear. It's engineered to actually use fear as fuel. Let's dig into how those low, fear-driven prices actually crank up the system's efficiency to the max. I love this quote from the source material because it just nails it. In most of finance, fear is a signal to get the heck out. But in this architecture, fear is simply a pricing opportunity. And this chart just lays it out perfectly. Look at the efficiency here. At a higher bull market price, maybe 5 cents, $100 takes 2,000 tokens off the market. But at the low, fear-driven price we saw on day 191, that same $100 removes over 6,000 tokens. Fear makes the supply reduction engine more than 3 times as powerful. It's incredible. And the result of that efficiency isn't temporary. It's permanent and significant. A full 18% of the entire PLAZM supply, we're talking over 2.5 million tokens, is gone forever. They can't be sold, they can't be reissued, they've been permanently removed. And that's a direct result of the protocol methodically buying back its own supply when it's on sale. But this whole strategy isn't just about playing defense by shrinking supply. It's also about playing offense. The protocol is actively scooping up productive assets while they are cheap. The easiest way to think about the buy and grow part of the engine is that it's basically DeFi's own automated dollar-cost averaging machine. Every single day, no matter what, it takes a slice of the yield and uses it to systematically buy more of the assets that generate that very same yield. So let's break down the strategic genius here. On the left, you see the cost. The protocol is getting these bonds on the cheap. But on the right, that's the real magic. Every bond it buys locks in the underlying ETH collateral at today's low price. That means when ETH eventually recovers, the Treasury's value and its yield-generating power are going to be supercharged. It's essentially front-running a recovery by buying future growth at a massive discount. And what's so important here is that this whole compounding machine is operating with clear skies ahead. For more than 80 days straight, there have been 0 scheduled token unlocks or releases. That means there's no artificial sell pressure hanging over the system, nothing to get in the way of these pure, uninterrupted compounding mechanics. Okay, so now let's pull back and model what all this strategic positioning actually means for the future. And to be clear, this isn't some price prediction. This is a structural analysis of how the system is literally built to react when sentiment finally decides to turn around. Just take a look at this table. The first column is where things were on day 191. The second is a simple scenario. What happens if ETH just goes back to $3,500? Look at the ripple effect. The vault's value in dollar terms jumps dramatically. And since the yield comes from that ETH, the daily yield also gets a huge boost. And that, in turn, juices the bond APR, making the whole system even more attractive and spinning that flywheel even faster. So let's wrap up our case study by going back to day 191 for one final check. We started with this thesis of an anti-fragile design. The big question is, did the protocol actually walk the walk when it was put under real-world extreme stress? Let's just run down the checklist. Did the yield engine do its job regardless of sentiment? Check. It churned out almost $400. Did the burn mechanism hit peak efficiency? You bet. Lower prices meant a bigger burn. Was buy and grow compounding at a discount? Check. It added bonds at bargain bin prices. Was the supply schedule clean? Check. Over 80 days clear. And the final ultimate test, did the vault actually grow in the middle of a panic? Check. A stunning 9 ETH flowed in, proving the entire thesis from top to bottom. Every single pillar of this anti-fragile design held up perfectly on one of the market's ugliest days. You have to understand, that is not an accident. That is architecture. And so I'll just leave you with this final thought to chew on. If this case study shows how this protocol is built to perform under conditions of extreme fear, what does that imply about its structural potential for when, not if, that sentiment finally swings back the other way? Thanks for joining me for this case study. And remember, one last time, this was all for educational purposes. Crypto is an incredibly volatile space, and what happened in the past is never a guarantee of future results. So please do your own research.